Welcome back to the deep dive, everyone. This is where we tackle those dense topics, the ones that maybe sound a bit intimidating.
Yeah, and we dive deep, unpack them.
Make them crystal clear for you. Today, we are plunging into the world of bonds.
Bonds. Yeah,
Now, if that word alone makes your eyes glaze over, well, you are exactly why we created this idea we call plebonomics.
exactly. Plebinomics, it's our whole philosophy here. We're all about taking these, complex financial ideas,
Making them simple.
simple, clear, and totally relatable
Yeah.
for everyone. Finance for the common people, the plebs, if you like.
Right. We think understanding money shouldn't be some kind of secret club.
Definitely not.
So our mission for this deep dive is, well, it's pretty ambitious. By the end of this chat, you won't just know what a bond is.
Hmm.
You'll genuinely get how it works, why it matters out there in the real world, and crucially, how you, a regular person, can actually think about them for your own finances.
Yeah, maybe even interact with them.
Expect some aha moments, we promise. We'll share some surprising bits, like where the word coupon actually comes from historically.
Oh, yeah, that villain.
And simplify all that jargon that feels like, designed to confuse. We want it to stick.
And that is precisely the goal.
Yeah.
Clarity and practical understanding. Because despite the sort of mystique around them sometimes, bonds are fundamentally a very old idea in finance.
Mm.
Really foundational.
Okay.
At their core, they're just a type of loan, plain and simple.
Alone.
But they are absolutely crucial for governments, for corporations. Think about it. Bonds pay for, well, everything. Roads, schools.
The stuff we use every day.
Exactly. New factories, research and development. They're kind of the bedrock, how modern economies get built.
Okay, so let's kick things off right there. Break down the absolute basics. We hear bonds thrown around all the time, especially in financial news, right? When interest rates change.
All the time, yeah.
But what is a bond at its most basic fundamental level? If we strip away all the financial jargon, what are we really talking about?
Okay, simplest terms. A bond is a type of security. It just means the issuer, that's the borrower,
The borrower.
owes a debt to the holder, that's the lender. You.
So it's like an IOU.
You can genuinely think of it just like that, an
Yeah.
IOU. A formal, legally binding promise to pay back money they borrowed.
Right.
So when you, as an investor, buy a bond, you are literally lending money. Could be to the government, federal, state, local.
Or it's company.
Or a company, yeah. And that issuer has a clear obligation, a duty. They have to pay back the principal that's the original amount borrowed.
The lump sum.
Right. Back to you at a specific date in the future, the maturity date.
Mm-hmm.
And usually they also pay you interest along the way,
Interest payments.
which in the bond world we call the coupon.
Or the coupon. Okay, so let me see if I've got this. It's like I lend my neighbor, say, $1,000 for a year,
Yeah.
and they promise formally to pay me back that $1,000 at the end of the year.
Right.
Plus maybe an extra $50 for the favor. Is that the basic idea?
Precisely. That $1,000 is the principal, the year is a maturity,
Mm-hmm.
and the $50 is your interest or the
Oh.
coupon.
Got it.
And it's interesting, the word bond itself, etymologically, it relates to bind.
Bind, like tying something.
Yeah, like an instrument that's binding one to pay a sum to another. That usage goes way back, like the 1590s.
Wow.
It's even in Shakespeare, The Merchant of Venice.
No kidding. So this isn't some newfangled financial thing.
Not at all. This idea of formal debt, obligation, it's deeply embedded in our financial history. Adds a nice historical flavor to our plebonomics lesson.
It really does. It's amazing how those old terms stick. Does that history affect how bonds work today beyond the name?
Not directly in the mechanics, no. But it just underlines how fundamental debt is as a financial tool. It's always been there. Now, building on that core idea, it's a loan. But let's clarify something really crucial right now.
Okay. What's that?
How is a bond different from a stock? Because people hear securities and might lump them together.
Right. Stocks and bonds, they're definitely not the same, are they?
Absolutely not. And this is critical for any investor to grasp. The big difference is fundamental. Stockholders, they have an equity stake.
Equity, meaning ownership.
Exactly. They own a piece of the company. They're owners. Bondholders, on the other hand, they have a creditor stake.
Creditor.
They're lenders.
Yeah.
You aren't owning part of the business. You're simply owed a debt by that business or by the government.
Okay. Lender versus owner.
And that difference becomes super important if things go wrong, like in a bankruptcy.
Ah, right. Who gets paid first?
Exactly. If a company goes bankrupt, Bondholders, as creditors, have priority. They get repaid before stockholders get a dime.
Before the owners.
Yeah. Now, they're not first in line. Secured creditors, people with claims on specific assets, they come before bondholders. But bondholders are definitely ahead of stockholders.
That's a huge difference.
It is. Another key difference, maturity. Bonds usually have a set term, a maturity date. When that date hits, the bond is redeemed, principal paid back, done.
Finite lifespan.
Right. Stocks, though, they typically hang around indefinitely, unless the company gets bought or, well, goes bust.
So they just keep existing.
Yeah, usually. There are some rare exceptions, like irredeemable bonds called perpetuities. No maturity date, but they're not common.
Okay, lender versus owner, fixed term versus indefinite. That makes a lot of sense. So if a bond is this loan with specific terms, what are its essential parts? The key details I should look for, like the ingredients in the recipe you said.
That's a great way to think about it. Yeah, like a recipe. A few core features define every single bond. First up, the principal.
Principal.
Also called face value or par value. This is simply the initial amount borrowed.
The $1,000 in my neighbor example.
Exactly. And it's typically the amount that gets repaid to you, the lender, when the bond hits maturity.
So I get that back at the end?
Usually, yes.
Yeah.
If a bond's face value is $1,000, that's what the issuer pays back. Now, sometimes with complex structured bonds, it can be different. But for standard bonds, that's the deal. For plebonomics, think of it as the original loan amount you get back.
Got it. Original loan amount back. What's next in the recipe?
Next is the maturity date, also called the term or the tenor.
The due date.
Simply the due date. The specific date when that principal is repaid to the bondholder. Once that payment's made, the issuer's obligation is finished.
How long can these terms be?
Oh, they vary hugely. Anything under a year, we usually call that a money market instrument, not really a bond.
Okay.
But most bonds are, say, shorter than 30 years, though they can be any length. In the U.S. Treasury market, for instance, we have categories.
You mentioned those. Bills, notes, bonds.
Right. Treasury bills are short-term, under a year. Notes are medium-term, usually 1 to 10 years. And bonds are long-term, 10 years out to 30.
And longer means more risk.
Generally, yeah. A longer maturity usually means higher risk, just because, well, more things can happen over 30 years than over 2 years, right?
Makes sense. More uncertainty.
So to compensate for that extra uncertainty, longer-term bonds typically offer higher interest rates, more potential reward for more risk over time.
Okay, that tracks. Principal maturity date. What about the actual money I make while I'm holding it? The interest.
Ah, that brings us neatly to the coupon and then to yield.
Coupon, like the thing you clip.
Exactly like that, historically. The coupon is simply the interest rate the issuer pays to the bondholder. For most standard bonds, fixed-rate bonds, this coupon rate stays the same for the entire life of the bond.
So always 3% or whatever it is.
Right. But then you also have floating rate notes, FRNs. Their coupon isn't fixed. It varies.
How does it vary?
It's linked to some benchmark, some reference rate that changes over time. Like SOFR, the secured overnight financing rate is a common one now. As that rate goes up or down, the bond's coupon payment adjusts.
Interesting. So it's not always fixed. Now, tell me about the clipping coupons thing. That sounds wild.
It does now, doesn't it?
Yeah.
But yeah, the term coupon literally comes from physical attachments on old paper bond certificates.
Like little tear-off slips?
Exactly. Bondholders would physically click off the coupon for that period, take it to a bank, and hand it in to get their interest payment.
Wow. Finance used to be very papery.
Very physical. Today, of course, it's almost all electronic. But the name stuck. These coupon payments are usually made semi-annually, so twice a year or sometimes annually.
Semi-annually is pretty common, right?
Very common, especially in the U.S.
Okay, so they pay me regularly based on that coupon rate, fixed or floating, and then I get my principal back at the end. But how does that translate into my overall return? Like, what's my actual profit percentage?
That's where yield comes in. Yield is the measure of the return you get from investing in the bond. There are a few ways to calculate it, but 2 are key for our plebonomics chat.
Okay, what are they?
First, there's the current yield, or running yield. Super simple calculation.
Simple is good.
It's just the annual interest payment, the coupon payment per year, divided by the bond's current market price. Not the face value, the price it's trading at right now.
Okay. Annual interest divided by current price. What does that tell me?
It gives you a quick snapshot of the cash flow you're getting relative to the price you pay today. Good for understanding immediate income.
But maybe not the whole picture.
Exactly. For the whole picture, you need the yield to maturity, or YTM, also called redemption yield. This is the big one.
YTM. I hear that term a lot.
You do. It's an estimate, and that's important. It's an estimate of the total annual return you'd expect to get if you buy the bond at its current market price.
Okay.
Hold it all the way until it matures,
Right.
and receive all the promise payments, both coupons and principal, exactly on schedule. It factors in the present value of all those future cash flows.
So it considers everything. The price I paid, the coupons, getting the principal back.
Yes, it wraps it all together into one annualized rate of return. It's the standard way to compare the potential returns of different bonds.
That sounds like the number I want. But you mentioned earlier a crucial caveat about reinvesting. How does that affect YTM for someone, say, living off the income?
Ah, yes, the reinvestment assumption. This is a key plevonomics point. The YTN calculation assumes that every single coupon payment you receive is immediately reinvested
Reinvested where?
back into another investment that earns that exact same YTM rate.
Ah, so if I just, spend the coupon payment.
Then your actual personal rate of return will likely be different from the calculated YTM. If you're spending the income, you're not getting the compounding benefit that's baked into the YTM formula.
So YTM is more like a theoretical benchmark for comparison.
It's a very useful benchmark, yes. It lets you compare bonds apples to apples, but for your actual experience return, especially if you're spending the income, it won't perfectly match the YTM. It's important to understand that distinction.
That's a really great clarification. Very plebonomics. What else defines a bond? What other ingredients?
Next up, super important, credit quality. This is all about default risk.
Default risk, the chance they won't pay me back.
Exactly. How likely is the borrower, the issuer, to actually make all the promised payments, principal and interest?
How do we know that?
Well, it depends on the issuer's financial health, the overall economic conditions, things like that. But to help investors gauge this, we have credit rating agencies.
Like Moody's, S&P?
Those are the big ones, yeah. Standard & Poor's, Moody's, Fitch. They assess the creditworthiness of bond issuers and assign ratings. You've probably seen them: AAA, AA, A, BBB, BBB, and so on.
Higher letters are better, right?
Generally, yes. AAA is the highest quality, lowest perceived risk. These ratings give investors a standardized way to quickly assess the default risk.
Hey, and we split bonds based on these ratings?
We do. We generally talk about investment-grade bonds versus high-yield bonds.
Investment grade sounds safer.
It is. These have higher ratings, typically BBB or Bay 3 and above, depending on the agency. Lower default risk, considered safer, and because they're safer.
They pay less interest, lower yield.
Exactly. Lower risk, lower yield. Then you have high-yield bonds, often called junk bonds.
Junk bonds. Doesn't sound great.
Huh. Well, the name tells you something. These have lower ratings, below investment grade. They carry a higher risk of default. And to compensate investors for taking on that extra risk,
They offer much higher yields.
correct, higher potential reward for taking on higher risk. You're essentially paid more for the chance that things might go wrong.
Makes sense. Risk and reward. Okay, what about the price they actually pay? You mentioned current market price when talking about yield.
Right, the market price. This is the price a bond actually trades for in the secondary market after it's been initially issued.
So not necessarily the $1,000 face value.
Often not, no. It's influenced by a bunch of things: the coupon payments it offers, how much time is left until maturity, the bond's credit quality or rating,
And interest rates.
and, crucially, the prevailing market interest rates. Come back to that big relationship. Now, when bonds are first issued, they often come out at par, meaning sold at 100% of their face value. So $1,000 for a $1,000 bond.
But after that, the price moves.
After that, yes, the market price can fluctuate. If market conditions change, especially interest rates, the bond might trade at a premium that's above par value, say $1,050, or at a discount that's below par value, maybe $950.
And this market price includes everything.
Usually when quotes are given, especially in the U.S., they talk about the clean price, which excludes interest accrued since the last payment. But the actual price you pay, the dirty price, includes that accrued interest. Europe often quotes the dirty price directly. Point is, the market price reflects the current value based on everything known about that bond and the market.
Okay, that's helpful. Price isn't fixed after issue. Are there any other, maybe more obscure features I should be aware of, even just for curiosity?
Yeah, there are a few more things, often tucked away in the details, for the curious plebe, as you say.
Lay it on me.
You have things like indentures and covenants. An indenture is the formal legal agreement, the contract, between the issuer and the bondholders.
The rule book.
Pretty much. It lays out all the terms: maturity, coupon, payment dates, etc. And covenants are specific clauses within that indenture. They define the rights of the bondholders and the duties or restrictions on the issuer.
Like things the company can't do.
Exactly. Maybe limits on taking on more debt or requirements to maintain certain financial ratios. They're designed to protect the bondholders. In the U.S., these are legally binding, very hard to change once the bond is issued without bondholder agreement.
So the fine print matters. What about those options you mentioned earlier?
Right. Optionality or embedded options. These give either the issuer or the holder specific rights. A really common one is callability.
Callability, meaning the issuer can call the bond back.
Precisely. A callable bond gives the issuer the right, but not the obligation, to repay the bond before its stated maturity date. This usually happens on specific predetermined dates, the call dates.
Why would they do that?
Almost always because interest rates have fallen. If they issued a bond paying 5% and now rates are 3%, they could call back the old expensive bond and issue new debt at the lower 3% rate, saving money.
Ah, refinancing, like with a mortgage.
Very similar concept. But for you, the investor, it means you get your principal back earlier than expected.
And you have to reinvest it.
At those new, lower prevailing rates. That's the reinvestment risk we talked about. Because of this risk to the investor, callable bonds usually offer slightly higher coupons to compensate.
So you get paid a bit more for the risk of it being called away. Makes sense. Is there an opposite? Can I demand my money back early?
Sometimes, yes. That's putability. A bootable bond gives you, the holder, the right to force the issuer to repay the bond before maturity, usually on specified dates.
When would I want to do that?
If interest rates have risen significantly, you might want your principal back to reinvest at the new higher rates. Or maybe if the issuer's credit quality drops and you get nervous. Because this option benefits the holder, bootable bonds usually trade at a premium. They cost a bit more.
So call is good for the issuer, put is good for the holder.
Generally speaking, yeah. One other feature to mention is a sinking fund provision.
Sinking fund. Sounds nautical.
It just means the issuer is required to gradually retire a portion of the bond issue over time before maturity.
How?
Either by calling randomly selected bonds for redemption or by buying them back in the open market. It reduces the total debt outstanding systematically and provides some assurance that funds will be available to repay the rest at maturity.
Okay, wow. That is a lot of potential features. But I guess the core things are still principal, maturity, coupon, and credit quality.
Absolutely. That's the core plebonomics takeaway. Understand those main parts, and you understand 90% of what makes any bond tick. You don't need to memorize every single embedded option.
Right. Focus on the fundamentals. Okay, so now we know the recipe for a bond. How does this all actually happen in the real world? How do bonds get created and, how do I get my hands on one?
Great question. It starts with issuance. That's the primary market, where bonds are first created and sold to investors.
The new bond market.
Exactly. The most common way this happens, especially for corporate bonds, is through underwriting.
Underwriting. What's that involve?
Usually one or more investment banks or securities firms form a group called a syndicate. This syndicate buys the entire bond issue directly from the company or government issuing it.
They buy the whole lot.
Yep, they take on the risk. Then, their job is to resell those bonds to investors, like pension funds, insurance companies, mutual funds, and sometimes individual investors.
So they're the middlemen taking the risk.
Right. The lead firms managing this process are called book runners. They structure the deal, advise the issuer on the best timing and price, contact potential investors to gauge interest, and essentially build the book of orders.
Okay, so that's how companies do it. What about governments, like U.S. Treasuries?
Governments typically use a different method, auctions.
Auctions, like selling art.
Sort of. For government bonds, the Treasury Department announces they're selling a certain amount of bonds with a specific maturity and coupon rate. Then, large financial institutions, and sometimes the public, submit bids saying what price they're willing to pay.
And the highest bidders win?
Well, it's usually based on the lowest yield they're willing to accept. The government accepts the bids that result in the lowest borrowing cost for them up to the amount they want to issue. The final price, and thus the yield, is determined by the auction results.
So the market sets a price through bidding. Interesting. Any other ways bonds get issued?
A couple of others. For smaller deals or to avoid the costs of underwriting, an issuer might do a private placement.
Selling directly.
Selling directly to a small number of sophisticated buyers, like insurance companies or pension funds. These bonds often aren't traded publicly afterwards. Historically, you also had things like the tap issue or bond tap.
Tap, like a faucet.
Yeah, the idea was the government would have an existing bond issue on tap, and they'd sell more of it gradually over time at a fixed price, depending on market demand. Less common now for major governments.
Okay, so that's how bonds are born in the primary market. But you said you don't have to hold them forever. How does trading happen after they're issued?
That happens in the secondary market. This is where bonds that have already been issued are bought and sold among investors.
Like a used bond market.
Exactly. And this is absolutely crucial for plebonomics.
Yeah.
It means you're not locked in until maturity. If you need your money back early, or if you think the bond's price has gone up and you want to take profits, you can sell it in the secondary market.
Are they easy to trade?
Modern bonds are negotiable, meaning ownership can be easily transferred. Forget those old physical certificates needing medallion stamps. Today, it's almost all electronic. And for many types of bonds, especially government and large corporate issues, the market is very liquid.
Liquid meaning easy to buy and sell.
Easy to buy and sell quickly without the transaction itself drastically moving the price. Now, unlike stocks, which mostly trade on centralized exchanges like the New York Stock Exchange,
Right.
most bond trading happens in a decentralized over-the-counter OTC market.
OTC, what does that mean?
It means trading doesn't happen in one central location. Instead, it happens directly between large dealers and institutional investors, connected electronically. Brokers and dealers hold inventories of bonds and, quote, prices, providing liquidity by risking their own capital.
So it's more like a network of dealers than a single stock exchange.
That's a good way to put it. Now, the absolute key thing to understand about trading in the secondary market.
Let me guess. Interest rates.
You got it. The inverse relationship between bond prices and interest rates.
Yeah.
This trips people up, but it's vital.
Okay, hit me with the seesaw analogy again. Make it stick for plebonomics.
Perfect. Imagine that seesaw. On one end, you have prevailing market interest rates. On the other end, you have the prices of existing bonds with fixed coupons.
Okay, seesaw in my head.
When interest rates go up, the bond price side of the seesaw goes down.
Rates up, prices down.
And when interest rates go down, the bond price side goes up. They move in opposite directions. Inverse.
Why, let's use that example again. The $1,000 bond paying $100.
Right. Your $1,000 bond pays a 10% coupon, so $100 a year. Let's say you bought it when market rates were 10%. Now market interest rates suddenly drop to 5%.
Okay, rates went down.
So new bonds being issued now only pay 5%, or $50 per $1,000. Your old bond paying $100 looks amazing, right?
Much better deal.
So investors will want your bond. They'll bid up the price. They'll pay more than the original $1,000 for it. How much more? They'll pay a price such that the fixed $100 coupon payment represents a 5% yield on their new, higher purchase price.
So the price goes up until the yield matches the market.
Exactly. In this case, the price would roughly double to $2,000 because $100 is 5% of $2,000. Your bond is now trading at a significant premium.
Wow. Okay, now the other way. What if rates go up, say, to 15%?
Okay, rates soar to 15%. Now new bonds are paying $150 per $1,000. Your bond, still paying only $100, looks, well, not so great.
Less attractive.
Much less attractive. Investors would rather buy the new 15% bonds. So to sell your bond, you'd have to lower the price. The price will fall below $1,000.
It trades at a discount.
Right. It trades at a discount. The price will fall until that fixed $100 coupon represents a 15% yield on the new, lower purchase price. In this case, it would fall to around $666.67 because $100 is 15% of $666.67.
Okay, that inverse relationship is crystal clear now. Rates up, price down. Rates down, price up. So just to double check for our listeners again.
Yeah.
If I plan to hold my bond until it matures,
Yes.
do these price swings matter as much to me?
That is a fantastic plebonomics point. If your plan is definitely hold that bond until maturity, these day-to-day or even year-to-year market price fluctuations are much less of a direct concern.
Oh, well.
Because, assuming the issuer doesn't default, you're still going to get all your promised coupon payments on schedule, and you're guaranteed to get the full principal, the face value, back on the maturity date, regardless of whether the price went up or down in the meantime.
So the market ups and downs don't affect my final payout if I hold on.
Correct. And there's a related concept called pull to par. As a bond gets closer and closer to its maturity date, its market price will naturally tend to move towards its par value, its face value.
Why does it do that?
Because everyone knows that on that maturity date, the bond will be redeemed for exactly par value. So as that date gets very close, the market price has less reason to be significantly different from par. It gets pulled back towards that $1,000 redemption value.
That's really reassuring for a long-term holder. The pull to par is like a gravitational force back to the original amount.
That's a great way to picture it. It provides a sort of anchor, especially as maturity approaches. Now, related to how much the price moves when rates change.
You mentioned duration.
Yes, duration. This is how the market measures a bond sensitivity, its price sensitivity, to changes in interest rates.
Like a sensitivity score.
Exactly. It's typically expressed in years, but think of it as a percentage change indicator. A bond with a duration of, say, 5 years is estimated to change in price by about 5% for every 1% change in interest rates.
So if rates drop 1%,
Its price should rise by about 5%.
and if rates rise 1%,
Its price should fall by about 5%. It's an estimate, not perfect, but it's the standard measure of interest rate risk.
so higher duration means more sensitive, more price swing.
Correct. Bonds with longer maturities generally have higher durations. Also, bonds with lower coupon payments tend to have higher durations. They're more sensitive to rate changes.
Why is that useful for me, the common investor?
It helps you manage risk. If you're worried interest rates are going to rise and you don't want your bond values to fall too much, you might look for bonds or bond funds with lower durations.
Less sensitivity.
Right. Conversely, if you think rates are likely to fall and you want to potentially capture more price appreciation, you might favor bonds with higher durations. It helps you align your bond holdings with your view on interest rates or just choose a level of sensitivity you're comfortable with.
Okay, duration is a key risk measure. Got it. So we've covered the mechanics, the trading, the big price-rate relationship. Now it sounds like there's just a huge variety of bonds out there, beyond just government or corporate. What are the main categories, the main flavors that a common investor like me might actually come across?
You're absolutely right. The bond universe is vast, much more diverse than people often think. They get categorized in different ways: who issues them, how long they last, special conditions.
Seems overwhelming.
You can see it that way. But the key insight for plebonomics, for us, is that you don't need to know every single type. Most individual investors will likely only encounter a few main categories, especially if they invest through funds, which bundle many bonds together and simplify things dramatically.
Okay, good. So what are the big ones to know about? Let's start with who issues them.
Okay, by issuer. First, the big one, government bonds, also called treasury bonds or sovereign debt.
Issued by countries.
Exactly. National governments issue these to fund public spending. Think U.S. treasuries, UK gilts, German bunds.
And these are the safest.
Generally considered the lowest risk category, yes, because they're backed by the full faith and credit, essentially the taxing power of the national government. Now, it's not zero risk. Some governments have defaulted historically, but for major developed countries, it's very low risk.
And lower risk means?
Lower yields, typically.
Mm.
And as we said, in the U.S., we distinguish them by term. Treasury bills under 1 year, notes 10 years, and bonds over 10 years.
Okay. Government bonds.
Hmm.
Low risk, low yield, different terms. What else?
You also have supranational bonds.
Mm.
These are issued by organizations that span multiple countries, like the World Bank or the European Investment Bank. They usually have very good credit ratings, often similar to top-rated governments.
Okay. Then you mentioned local governments?
Yes, municipal bonds, or munis. These are issued by state governments, cities, counties, school districts, other local authorities.
Why would I buy a muni?
The big attraction, especially in the U.S., is their tax status. The interest income from most munis is typically exempt from federal income tax.
Tax-free income. Nice.
And often, if you live in the state that issued the bond, it might be exempt from state and local taxes too. This makes them particularly attractive for people in higher tax brackets. Their after-tax yield can be higher than a taxable bond with a similar risk level.
Interesting. So taxes are a big factor there. What about companies?
Corporate bonds, issued by corporations, obviously, to fund everything from building new factories to research to day-to-day operations.
Riskier than government bonds?
Generally, yes. The risk depends heavily on the specific company's financial health. Because they're riskier, they offer higher yields than government bonds of similar maturity.
And within corporates, you have the junk bonds.
Right, the high-yield bonds or junk bonds. These are corporate bonds issued by companies considered less financially stable, so they have credit ratings below investment grade. Much higher default risk.
And much higher yields to compensate.
You got it. High risk, high potential reward.
Are there bonds focused on specific causes, like green bonds?
Yes, absolutely. Climate bonds or green bonds are a growing category. These are issued specifically to raise money for projects that have positive environmental benefits or help adapt to climate change.
So my money goes towards something specific and green.
That's the idea. Governments and corporations issue them. The UK started issuing sovereign green bonds in 2021, for example. There are also social impact bonds, where private investors fund a social program and the government pays them back, possibly with a return, only if specific positive social outcomes are achieved, leading to public savings.
Fascinating. What about those bonds made by bundling other loans?
Ah, asset-backed securities, ABS.
So,
These are bonds whose payments come from the cash flows generated by a pool of underlying assets.
like mortgage.
Mortgage-backed securities, MBS, are the most famous type of ABS, Payments from thousands of homeowners' mortgages are pooled together, and bonds are issued backed by those payments. But ABS can be backed by other things too, like auto loans, credit card receivables, student loans. The risk is tied to the quality of those underlying assets.
So it's a bit more complex. The risk depends on the loans inside.
Definitely more complex. There are also covered bonds, common in Europe. They're similar, often backed by mortgages or public sector loans, but crucially, the assets backing the bond remain on the issuer's balance sheet, offering potentially more security to the bondholder than typical ABS. And subordinated bonds, which have a lower priority claim than other bonds if the issuer goes bankrupt, making them riskier and typically offering higher yields.
Okay, lots of variations based on the issuer and what backs the bond. What about categories based on the term or length?
Right, by term.
Uh,
We already mentioned short, medium, and long-term bonds as general categories, like maybe under 5 years, 15 years, over 15 years, the definitions vary.
are there really long ones?
Oh yeah, there are perpetual bonds, or perps. These have no maturity date at all.
No maturity. They just pay interest forever.
In theory, yes. The UK government used to issue these called consols. Some still exist. And there are ultra-long bonds issued by companies like a West Shore Railroad bond, reportedly maturing in 2361. For practical purposes, those are virtually perpetuities.
2361. Wow. Who buys those?
Institutions with very long-term liabilities, like pension funds or life insurance companies. We're seeing more Methuselah bonds being issued now with maturities of 50 or even 100 years, partly due to demand from these kinds of investors needing to match long-term payouts.
Incredible. Any other term types?
You might see serial bonds. These aren't one single maturity date, but parts of the issue mature in installments over several years.
Okay. What about how they pay? Fixed, floating, anything else?
Yeah, by conditions payments.
Yeah.
We covered fixed rate, constant coupon, and floating rate notes, variable coupon.
Yeah.
Then there are zero coupon bonds, zeros, or strips.
Right. The ones with no interest payments.
Correct. No regular coupon payments. You buy them at a significant discount to their face value, par value. Then, at maturity, you receive the full face value.
So your entire return is the difference between the low price you paid and the face value you get back.
Exactly. The interest effectively accrues internally and is paid as one lump sum at the end. U.S. Treasury bills are technically zero coupon instruments. You can also create zeros by stripping the coupons off a regular fixed-rate bond and selling the principal part separately.
Clever. What about protecting against rising prices?
That's where inflation index bonds come in, often called linkers, or in the U.S., TIPS, Treasury Inflation Protected Securities.
How do they work?
With TIPS, the principal value of the bond is adjusted up or down based on changes in the Consumer Price Index, CPI, a measure of inflation.
So if inflation goes up, the bond's value goes up.
The principal value adjusts up, and the coupon payments, which are a fixed percentage of the adjusted principal, also go up. This is designed to protect your purchasing power, providing a real return above inflation.
That seems really useful in inflationary times.
Very much so. One more quirky one, lottery bonds. Interest is paid normally, but some bonds from the issue are randomly selected to be redeemed for more than their face value, like winning a lottery prize. Less common, but they exist.
Okay, that's a fun one. What about bonds with options for me, like changing it into stock?
Ah, yes. Bonds with embedded options for the holder. A key type is the convertible bond.
Convertible.
It gives the bondholder the right, under certain conditions, to exchange the bond for a predetermined number of shares of the issuing company's common stock.
So I can switch from being a lender to an owner.
Exactly. It's a hybrid security, part debt, part equity. Offers the safety of bond payments, but the potential upside if the company's stock price does really well. There are also exchangeable bonds, which are similar, but they convert into shares of a different corporation than the issuer.
Interesting hybrids. Okay, just a couple more categories maybe. How were bonds tracked historically? Paper.
Right. By documentation evidence of title. It's mostly historical now, but interesting. You had bearer bonds.
Bearer bonds. I've heard of those, like in movies.
Yeah. These were actual physical paper certificates, and crucially, they didn't have the owner's name registered anywhere. Whoever physically possessed the certificate, the bearer, could claim the interest and principal payments.
Seems risky. What if you lose it?
Exactly. Lost or stolen meant the value was gone. They were also used historically to hide wealth or evade taxes because there was no ownership record. For those reasons, they've been prohibited in the U.S. since 1983 and are rare globally now.
So what replaced them?
Register bonds. Here, the ownership is recorded by the issuer or a transfer agent. Payments are sent directly to the registered owner. Safer, but not easily transferable.
And today?
Today, almost everything is book entry bonds. There's no paper certificate at all. Ownership is recorded purely electronically in a central depository system. Much more efficient, lower cost. This is the standard now.
Makes sense. Less paper, less hassle. Last couple of types.
Just to round it out, retail bonds. These are specifically designed and marketed towards ordinary individual investors, often with lower minimum investment amounts, and foreign currency bonds issued by a government or company in a currency other than their home currency, like a Japanese company issuing bonds in U.S. dollars, a Yankee bond, or a non-Japanese company issuing bonds in Japanese yen, a samurai bond. They do this maybe for stability or to access foreign capital markets. The downside for the issuer is they lose the option to inflate away their debt using their own currency.
Wow. Okay, that's an incredible tour of the bond zoo. So many different species. But like you said, the plebonomics view is we don't need to know them all intimately, but understanding the main types, government, municipal, corporate, maybe inflation-linked, gives us a good map.
Exactly. And knowing the basic categories helps you understand what might be inside a bond fund you're looking at.
Right. So with all these different flavors, let's circle back to the big question for the common investor. Why? Why should a pleb like me actually want bonds in my portfolio? What's the big picture advantage?
It's a great question. Bonds really play several crucial roles, offering benefits that stocks, for instance, typically don't. The first, and maybe most important for many, is capital preservation.
Protecting my initial investment.
Precisely. Unlike stocks, where the value can go down and stay down, bonds are fundamentally designed to repay your principal, that initial amount, at a specified future date. That structure provides a level of safety that's very appealing if you don't want to risk losing your starting capital.
Is there evidence they actually preserve capital?
Historically, yes. Investment-grade bonds, as a broad category, have a remarkable track record. Over the last 90 years or so in the U.S., there hasn't been a single 5-year or 10-year period where they delivered negative total returns. Individual bonds can default, of course, but the asset class itself has shown resilience.
That's pretty compelling for safety.
It makes them really good for meeting specific future financial goals. If you know you need a certain amount of money for, say, a down payment in 5 years or for retirement income starting in 10 years, bonds can provide a high degree of certainty about having that capital available when you need it.
Okay, capital preservation is benefit number one. What's number two?
Income. Regular, predictable income.
The coupon payments.
Exactly. Most bonds are fixed income securities for a reason. They provide those coupon payments on a set schedule, could be quarterly, semi-annually, annually. It creates a steady, predictable cash flow stream.
How does that compare to, say, stocked dividends?
It's generally more reliable. Bond coupon payments, especially from high-quality issuers, tend to be quite dependable. And crucially, they are a legal obligation of the issuer. A company must pay its bond interest unless it's going bankrupt.
Whereas dividends?
Dividends are discretionary. A company's board can decide to cut or suspend dividend payments at any time if business is tough or they want to reinvest the cash. Bond interest payments are much more secure in that sense and often larger as a percentage of the investment value.
Predictable, obligated income. Got it. Benefit three, can they grow too?
Yes, potentially. Capital appreciation or price gains.
Even though they're loans?
Yes, because they trade in the secondary market. While many people buy bonds intending to hold them to maturity for the income and principal return, the market price does fluctuate before maturity.
Because of interest rates changing?
That's the main reason, yes. If interest rates fall after you buy your bond, its price will likely rise. Or if the issuer's financial health improves unexpectedly and its credit rating gets upgraded, the price can also go up.
So I could sell it for more than I paid?
You could. Selling a bond before maturity for a profit results in a capital gain. This capital appreciation adds to your income from coupons to give you your total return. It's not usually the primary goal with bonds, but it can definitely boost overall results.
Okay. Preservation, income, potential appreciation. What else?
A huge one. Diversification.
Not putting all your eggs in one basket.
Exactly that. Including bonds in a portfolio that also holds stocks helps to diversify and balance out the overall risk. Stocks and bonds often behave differently in different market conditions.
How so?
When stock markets are volatile or heading down, high-quality bonds often hold their value better, or might even go up in price as investors seek safety. They act as a cushion, reducing the overall bumps in your portfolio's value. Their volatility, especially for short and medium-term bonds, is generally lower than stocks.
So they smooth out the ride.
They can, yes. It's about building a more resilient portfolio that can handle different economic weather.
Does that link to how they perform in downturns?
It does. Bonds can be a potential hedge against economic slowdown or deflation.
How does that work?
During an economic slowdown, corporate profits might fall, hurting stock prices. But the fixed income payments from your existing bonds keep coming, assuming no default. That reliable income stream becomes more valuable.
And in deflation, when prices fall.
Deflation is actually great for existing bondholders. If prices generally are falling, the fixed amount of money you receive from your bond coupons actually buys more goods and services. Your purchasing power increases. This makes bonds very attractive in deflationary periods, potentially increasing demand and pushing their prices up, so they can offer a valuable counterweight when the economy struggles or prices fall.
Okay, so the big picture benefits are safety of principal, reliable income, potential for price gains, diversification from stocks, and good performance in slowdowns or deflation. That's a strong case.
It is. They play a really important role in building a balanced long-term investment strategy.
But, there's always a but, right? They sound great for stability and income. Is there a catch? What are the downsides, the risks I really need to be aware of? What does Plubonomics need to warn me about?
Absolutely. No investment is risk-free, and bonds are no exception. While generally safer than stocks, they definitely have their own set of risks. The big one, especially for fixed-rate bonds, is interest rate risk.
We talked about this with the seesaw. If rates go up, my bond's price goes down.
Exactly. If you hold a bond paying 3%, and new bonds start being issued at 5% because market rates have risen, your 3% bond becomes less attractive. Its market price will fall to compensate.
So if I need to sell it early,
You might have to sell it at a loss compared to what you paid. Now again, for Plubonomics, remember, this doesn't affect your coupon payments or the principal you get back if you hold to maturity, but it directly impacts the market value before maturity. And if you own bond funds, the fund's value, its net asset value or NAV, will go down when rates rise, reflecting the falling prices of the bonds it holds.
and duration tells me how much risk.
Duration quantifies that sensitivity, yes. Higher duration, more price movement when rates change.
Okay, interest rate risk is number one. What's next?
Credit risk, or default risk.
The risk the issuer just doesn't pay.
Yes. The probability that the borrower, the company, or government will fail to make its promised payments, either missing an interest payment or failing to repay the principal at maturity.
How likely is that?
It depends entirely on the issuer. That's what credit ratings try to measure. U.S. Treasury bonds have extremely low default risk. Junk bonds have a much higher, non-trivial risk of default.
What happens if my bond's rating gets lowered?
An unexpected credit rating downgrade will almost certainly cause the bond's market price to fall, as investors now see it as riskier than before.
And if they actually go bankrupt?
In a bankruptcy, as we said, bondholders are ahead of stockholders, but they're typically behind secured creditors. There's absolutely no guarantee you'll get all your money back. You might get back pennies on the dollar, or maybe a significant portion. It depends on the specifics of the bankruptcy.
Do you have an example?
A famous one is WorldCom. After their massive accounting scandal back in 2002, the company went bankrupt. Their bondholders eventually recovered only about 36 cents for every dollar of principal they were owed.
Wow. Less than 40%. That's a serious risk.
It is. It highlights that even bonds aren't immune to catastrophic losses if the issuer fails.
Okay, rate risk, credit risk. What about that callability thing again? You mentioned reinvestment risk.
Right? Call risk and prepayment risk, leading to reinvestment risk.
Remind me how that works.
If your bond is callable, the issuer can choose to repay it early. Usually because interest rates have fallen, they refinance their debt more cheaply.
Good for them, but bad for me.
Bad for you, because you get your principal back sooner than planned, and now you have to reinvest that money in a market where interest rates are lower than when you bought the original bond. You might be forced to accept a lower yield on your new investment.
So my future income stream gets reduced.
Potentially, yes. This is particularly common with mortgage-backed securities. When homeowners refinance their mortgages en masse because rates have dropped, those loans get paid off early, which forces the MBS investors to get their principal back early and reinvest at lower rates.
Okay, call risk is definitely a risk to my returns. What about trying to sell when I want to?
That's liquidity risk, the risk that you might not be able to sell your bond quickly at a fair market price.
Is that common?
For major government bonds or large, actively traded corporate bonds, liquidity is usually very good. But for smaller municipal bonds or bonds from less well-known companies or bonds traded only in the OTC market, it might be harder to find a buyer immediately, especially if the market is stressed. You might have to accept a lower price than you'd like if you need to sell urgently.
So it could be hard to get out quickly without taking a hit on price for some bonds. Makes sense. What about inflation?
Inflation risk. This is a big one for traditional fixed-rate bonds.
Because my fixed payment buys less stuff.
Exactly. If you have a bond paying a 4% coupon, but inflation is running at 3%, your real return, your actual increase in purchasing power, is only 1%. If inflation spikes to 5%, your real return is actually negative. Your investment isn't keeping pace with rising prices.
So inflation erodes the value of my fixed payments.
It absolutely does. That's why those inflation index bonds, 2PS, were created specifically to combat this risk by adjusting payments based on inflation.
Got it. Are there any other risks lurking out there?
A few others worth knowing. Event risk. The risk of some unforeseen event hitting the issuer, a natural disaster, a major lawsuit, a regulatory change that negatively impacts their ability to pay. Exchange rate risk. If you hold bonds denominated in a foreign currency, changes in the exchange rate can hurt or help your return when you convert back to your home currency. Sovereign risk. The specific risk that a national government might default on its bonds, and yield curve risk. The risk that the shape of the yield curve itself changes, the relationship between short-term and long-term rates, which can impact bond portfolio values in complex ways.
Okay, quite a list of potential pitfalls. Interest rate risk, credit risk, call risk, liquidity risk, inflation risk. It's definitely not risk-free.
Not at all. Understanding these risks is just as important as understanding the benefits. It's about finding the right balance for your own situation.
So now I feel like I've got a decent handle on what bonds are, the different types, the pros, and importantly, the cons or risks. If I decide, okay, I want some bonds in my portfolio for stability or income, how do I actually do it? As a common investor, what are the practical steps? Can I just call up my broker and buy one? Or are funds the way to go?
That's the practical question, right? How do you get started? There are a couple of main pathways, and honestly, for most people, the plebonomics approach often points towards the indirect routes for simplicity and diversification.
Indirect meaning funds.
Generally, yes. But let's cover buying individual bonds first. You absolutely can do this.
How?
You can purchase them directly from the issuer in some cases, like U.S. Treasuries and TIP Test, which you can buy straight from the government via the Treasury Direct website. That's quite straightforward.
Okay, for government bonds, what about corporate or muni bonds?
For those, you typically go through a financial institution or an online brokerage account. You tell your broker what you want to buy or browse what they have available.
What are the challenges with buying individual bonds?
It requires a bit more homework. You need to understand the specific bond's features, its credit rating, the issuer's financial health. You need to be comfortable assessing that credit risk yourself or relying on ratings. Also, minimum purchase amounts can sometimes be high, especially for corporate bonds, maybe $5,000 or $10,000 or more per bond. And as we mentioned, liquidity can be lower, meaning it might be harder to sell that specific bond quickly before maturity if you need the cash. Plus, brokers usually charge commissions or markups when you buy or sell individual bonds.
So more work, potentially higher costs, maybe harder to sell. What's the upside?
The main upside is control. You pick the exact bond, the exact maturity date. And if you hold that individual bond to maturity, you largely insulate yourself from the day-to-day price swings caused by interest rate changes. You know you'll get your coupons and principal back, assuming no default.
Okay, direct ownership has pros and cons. What's the alternative you mentioned? The funds.
Yes. Buying bond funds. This is overwhelmingly the most common way for individual investors to get bond exposure, and usually what we'd recommend for most people starting out under the plebonomics banner.
Why are funds often better for individuals?
Two main reasons: diversification and simplicity professional management.
Okay, break those down. Diversification first.
When you buy shares in a bond fund, you're not buying one bond. You're buying a tiny piece of a large portfolio that might hold hundreds or even thousands of different bonds from many different issuers.
So if one bond defaults,
It has a much smaller impact on your overall investment compared to if that was the only bond you owned. The risk is spread out significantly. That's huge diversification benefit.
and simplicity.
The fund is managed by professional portfolio managers. They do the research, select the bonds, monitor credit quality, manage maturities, handle the trading. You don't have to worry about picking individual bonds or tracking ratings yourself. You just choose a fund that matches your goals.
Hmm.
Maybe a U.S. Treasury fund, a corporate bond fund, a high-yield fund, a global bond fund, etc., and the manager handles the rest.
Okay, diversification and professional management sound good. What types of funds are there? You mentioned mutual funds and ETFs.
Right, those are the two main structures. Bond mutual funds are the traditional type. You buy shares directly from the fund company or through a broker. Orders are typically processed once per day at the net asset value, NAV, calculated after the market closes. They often have various share classes with different fee structures.
And ETFs.
Bond exchange-traded funds, ETFs, have become incredibly popular. They also hold a portfolio of bonds, but the fund itself trades like a stock on major exchanges throughout the trading day.
So I can buy or sell ETF shares anytime the market is open.
Exactly, just like a stock. Bond ETFs are generally known for being very cost-effective, often with lower annual expense ratios, management fees, than comparable mutual funds. They also usually have very low minimum investment amounts, making them super accessible. You buy and sell them through any standard brokerage account. And both mutual funds and ETFs typically distribute the income earned from their bond holdings to shareholders regularly, often monthly or quarterly.
So for most people, buying a diversified, low-cost bond ETF sounds like a really sensible way to add bonds.
For the vast majority of individual investors looking for bond exposure, yes, it offers instant diversification, professional management, ease of trading, and usually low costs. It ticks a lot of the plebonomics boxes for simplicity and effectiveness.
Okay, funds seem like the go-to. Are there any specific strategies people use, maybe even with funds or individual bonds, beyond just buying and holding?
Yes, there are a few common strategies investors use to manage their bond holdings. One is the bond ladder.
Ladder, like climbing steps.
Kind of. It's usually done with individual bonds, though you could approximate it with target maturity bond funds. The idea is to spread your investment across bonds with different maturity dates, spaced out over time.
How does that look?
You might buy bonds that mature in 1 year, 2 years, 3 years, 4 years, and 5 years. Then, as the 1-year bond matures, you take that principal and reinvest it into a new 5-year bond at the end of the ladder. As the 2-year matures the following year, you buy another 5-year bond, and so on.
What's the point of doing that?
It helps manage interest rate risk. You're not locking all your money into one specific maturity or interest rate environment. You always have some bonds maturing relatively soon, giving you cash flow and the opportunity to reinvest at current rates. It smooths out the impact of rate changes over time.
Okay, laddering for steady reinvestment. What else?
There's the barbell strategy.
Barbell, heavy weights on the ends.
Exactly the image. Here, you concentrate your bond investments at the two extremes of the maturity spectrum. Very short-term bonds and very long-term bonds, with less in the middle.
Why do that?
The short-term bonds provide liquidity and less price risk if rates rise, allowing you to reinvest sooner. The long-term bonds typically offer higher yields, coupons, and potentially more price appreciation if rates fall. You're trying to get benefits from both ends of the maturity spectrum.
Interesting trade-off. Ladder versus barbell. Now, what about how fund managers actually pick bonds? You mentioned active versus passive.
Right, the active versus passive debate exists in bonds just like in stocks.
Passive first. That sounds simpler.
Passive strategies generally involve buying and holding bonds, often through index funds or ETFs that aim to simply replicate the performance of a broad bond market index, like the Bloomberg U.S. Aggregate Bond Index, often called the AG.
So just trying to match the market return.
Exactly. The goal isn't to beat the market, but to capture the market's return efficiently and at low cost. Focuses on capital preservation, income, diversification. For many plebonomics investors, passive bond index funds are a fantastic core holding.
And active, they try to do better.
Active strategies involve managers actively trying to outperform a benchmark index. They make deliberate choices about which bonds to buy and sell based on their research and market forecasts.
How do they try to beat the market?
They use various techniques. Maybe intensive credit analysis to find mispriced bonds, macroeconomic analysis to predict interest rate movements, shifting money between different sectors, government, corporate, high yield, adjusting the portfolio's overall duration based on rate forecasts, positioning along the yield curve, maybe trying to capture a roll-down return as bonds get closer to maturity and move down a typically upward-sloping yield curve. Some even use derivatives.
Sounds complicated. Do they succeed?
That's the big debate. The bond market is generally considered quite efficient, making it hard for active managers to consistently beat their benchmarks after accounting for their higher fees. Some argue they can add value through skill, especially in less efficient corners of the market, like high yield or emerging market debt. But many studies show that, on average, passive index funds tend to outperform the majority of active funds over the long term, largely due to lower costs.
So for plebonomics, passive might be the easier, often more reliable path.
Often, yes. But understanding that active management exists and what it tries to do is useful context.
Absolutely. Well, this has been incredibly enlightening. So there you have it, bonds. From what felt like a dense, maybe boring topic,
Not boring.
to understanding them as a fundamental IOU, a loan that powers governments and companies and acts as a really powerful tool for investors seeking stability, income, and diversification. They're far from just jargon.
Absolutely. They are a core part of the financial system, and understanding them, even at this basic plebonomics level we've discussed, really empowers you. It gives you essential knowledge to navigate your own financial journey with more confidence. They can truly add that stability, that predictable income, which is so valuable, especially alongside potentially more volatile investments like stocks.
It all comes back to that core idea, doesn't it? Borrowing and lending, a promise to repay, something we all understand fundamentally. It's about leveraging money to build things, to grow, whether it's a new factory for a company or a new school for a community.
That's the essence of it. Trust and obligation, formalized into an investment.
So, as you, our listener, think about your own financial future, maybe consider this. How might understanding this fundamental power of lending, maybe through something as accessible as a bond fund, change how you view your savings or your long-term goals? Was it the safety, the income, the diversification? What stands out to you most from our deep dive today about the promise, the power, and maybe even the risks of a bond? Something to mull over. Join us next time on the deep dive.